So, student of CPA, it's another perfect morning, guys. We meet for this session. So, my name is CPA Debenture. We have been doing many sessions from time to time, that is. So, for today, I would like to look at advanced financial reporting and analysis. So, in this advanced financial reporting and analysis, we know that there's many topics to be covered, but I cannot cover all of them in one session. Of which you know that already I've covered many topics based on the other videos I've done. So, on today's session, I would like to look at the topic of reconstruction and reorganization of capital structure. That is the reconstruction and reorganization of the capital structure. To be more specific, when you don't have any scheme of capital reorganization, so whereby you are told to suggest a scheme of capital reorganization. So it's all about the topic for today will be on proposing stroke suggesting a scheme of capital reorganization. Suggesting a scheme of capital reorganization. So this is an area under the reconstruction and the reorganization of capital structure. So for us to talk about this topic, that is proposing stroke suggesting a scheme of capital reorganization, and that is in AFR, Advanced Financial Reporting, December 2023 sitting question 5. So for us to address this issue of proposing a scheme of capital reorganization, I would like to look at a question of December 2023 question 5, the Advanced Financial Reporting and Analysis. The Advanced Financial Reporting and Analysis. So there's another question I've done for the same area, that is from 2008. But the question for today was a bit tricky. That is why I'm considering to do it. So before even I start reading the question, I would like to request that as a student, as a professional, you share this link. You know that you can share the link to your friends. And remember to subscribe to this channel before even we start. So in 5 seconds, I can request that you do that. That is in 5, 4, 3, 2, 1. So thank you for subscribing and at the same time sharing this link to other students. So this is the relevant question. I have the hard copy version of the question. I have the hard copy version of the question, or which at the same time, if you want to access this question, under the information provided down here in this video, there's a link I have attached. So you can check there, you will be able to access this past paper. Or as a student of CPA, you know that you can register with the MyRoft app to get the past papers. MyRoft app. So that when they ask you an institution, you use KASNEB. And for other things is the email you used when you were registering with the KASNEB, and also your own password. Password is your choice. Huh? So this one is your choice. So to access all the past papers, just go and download this app, register. Institution is KASNEB. Hi. So the question is, for a number of years now, A Limited has been reporting operating losses. Principally, that is principally due to the competition from firms operating in the same sector. A Limited is now considering reorganizing its operations and the financial structure to allow it to obtain new fundings required to develop and launch a new product. Technical experts have indicated that the new product will do well in the market once it's launched. Statement of financial position of A Limited as at 31st October 2023 is as follows. So you are given the statement of financial position. Additional information, number 1, preference dividends have been in arrears for 3 years. Number 2, retained earnings balance is to be eliminated. Number 3, the following details relates to the assets. Tangible assets, 15% of the book value is to be transferred to bondholders for an agreed value of shilling 720 million in full settlement of the debt, and remaining book value of these assets marked up to 110%. Inventories include obsolete items worth 540 below their book value of 680 million. A bond investment having 10 months to maturity is to be revised to shillings 280 million from its carrying value of 370 million. Receivables with a carrying value of shillings 1,200 million are to be factored out for 70% advance under terms that will allow for refund of any difference between actual correction and the upfront payment from the factor. One customer who owes shillings 828 million is in serious financial difficulty. Only 50% is expected to be received from the customer in 1 year's time. Number 4, the bank has demanded repayment of bank overdraft, while the financing institutions has accepted to receive 92% of their existing loans in new ordinary shares as full settlements. Upon successful completion of the reorganization process, however, the financial institution is ready to immediately buy 15% shillings 900 million debentures in the reconstructed entity's debts, provided that the directors will attach the right to convert the debt into shares at maturity. The financial institution will also require 10% discount on the convertible debt at issue and a repayment period of 3 years. The effective rate of interest on this convertible debt, if the discount is granted, is estimated to be 18.7%, and the effective rate of interest on an equivalent non-convertible instrument will be 22.5%. Number 5, existing ordinary shareholders are prepared to inject shillings 4,200 million for 840 million new ordinary shares, while preference shareholders have pledged to finance new production equipment whose estimated fair value is shillings 1,350 million. Each of these shares currently has a value of shillings 5. Number 6, a half of the trade payables, those are the suppliers. Remember, creditors are your suppliers. So a half of the trade payables have agreed to be paid using ordinary shares in the reconstructed firm. Number 7, the directors have projected annual profit before interest and tax in the reconstructed entity to be 650 million. Number 8, a firm order has been received from BB Limited, that is another company, a competitor, to buy all the business assets for shilling 7,200 million. 60% of these proceeds relating to tangible assets, closure cost are estimated at shillings 50 million. Number 9, assume a discount rate of 15% unless a different rate is more appropriate. Number 10, the present value of shillings 1 receivable at the end of the year for different discount rates is provided below. You can see as per note 10, there is a discount rates of 10%, 15%, 18.7, and 22.5. Required, suggest a scheme of capital reorganization that could be applicable to all stakeholders, including a revised statement of financial position. So for this one, I can say it was an average question, and it was a bit difficult for other students, but it cannot be difficult up to 60%, no, maybe 50%. There is no difficult question when at least you know the procedure you are supposed to follow and what you can do. So in this question, remember that you are supposed the first step you are supposed to do, or the first thing you are supposed to do is all about the determination of expected proceeds. So we already know that there is a BB remitted, which came in according to note 8, that a firm order has been received from BB Limited, a competitor, to buy all business assets at 72 million. That is 7,200 million. So remember that once you have these proceeds, you have to distribute. So the distribution of those proceeds, expected proceeds. So there's that order of distribution whereby you start with the reconstruction cost or the liquidation cost. On this note 8, they were calling it closure cost. So after you have your proceeds, there's your closure cost. Then what's remaining now is available to any creditor who is secured. Who is secured. So I can see under the statement of financial position, there is secured. Bank overdraft is secured. Then the balance available is going to be attributable to the unsecured. Unsecured, we have bonds, payables, and loan from financial institutions. That is according to the statement of financial position. So the only one who was secured is the bank overdraft. And now once you have considered the unsecured, the balance which is remaining is available to the shareholders. So we have the two shareholders in this question, ordinary shareholders and preference. So for the preference, you have to pay dividends. And finally, the balance available will be attributable to ordinary shareholders. So first step, you do that. And now the next thing is all about the determination of maximum loss. Maximum loss. So you check at items right now, accumulated losses, those are losses. Preference dividends in arrears, those are losses, because if the preference shareholders will not be paid dividends, they will make a loss. Increase in assets, decrease, that is increase in assets, that is a gain, decrease is a loss. We have a decrease in liabilities, that is a gain, increase is a loss. So losses against gains, you get your maximum loss. After determination of the maximum loss, remember that if there is any loss, that loss must be obvious, shared to the available shareholders based on the proportion of their share capital. Then after that, you can give other proposed changes. That is step 3. Other proposed changes can be done. And after you have other proposed changes, then now you do the revised statement of financial position. So we can do our step 1, as I have already explained, that we have the expected what? Expected proceeds. So our expected proceeds is 7,200. It's not a must I distribute to tangible, because they mentioned that tangible will take tangible 60%. So other assets will be 40%. It's the same thing. If you take 60% of 7,200 and this one, 40% of 7,200, at the end, you will be able to get 72. So there's no difference of saying 7,200. So then the first thing you consider is all about now distribution. So you do your distribution of these proceeds. So distribution. So I've said you start with reconstruction cost. So here they were calling it closure cost. So closure cost is all about 50. After that, you raise secured creditors. So for the secured creditors, I can see there is what we call bank overdraft. From the statement of financial position, we have bank overdraft. And that bank overdraft is stated at 3.9. So that now, up to this point, we have the balance available to unsecured and available to unsecured creditors. So the unsecured creditors. So we can use our calculator. So 7,200 minus 50 minus 3,900. So this is 3250. So secured, that is unsecured creditors or unsecured liabilities. So all other liabilities other than the one which was secured, all other liabilities. Right now there was 20% bond, 20% bonds. So 20% bonds, here we have 750. Trade payables, 1968. We have loans from finance institutions. So loan from financial institution, 925. So 750 plus 1968 plus 925. So yeah, I am having 3643. But so far we have 32 what? They are available to these people is 3250. So 3250. But now they are claiming 3643. But we can only distribute 3250. Meaning that what is available to the shareholders? Nil. There's nothing which can be available to shareholders. Available to shareholders is what? Nil. So if there was some balance, that is when we could have paid preference dividends. Then the balance, after paying the dividends, the balance is attributable to who? To ordinary shareholders. The balance will be attributable to ordinary shareholders. So after this, I have said now we determine what? Determine the maximum loss. Determine maximum loss. So we have shillings in millions. So even this one was shillings in millions. According to the question, shillings in millions. So we have shillings in millions. So maximum loss. So the first thing to consider, even from the additional information itself, I can just start from note 1 going down. There was preference dividends in arrears. So if this one, they were in arrears. So if they will not be paid, these people will suffer. That is a loss. So dividends in arrears, preference dividends in arrears. Remember that dividends were paid at 20%. That is from the statement of financial position. The share capital, they are saying 20% cumulative preference share capital, 1,500. According to note 1, the preference dividends were in arrears for how many years? 3 years. So you have to multiply it with the 3. So 0.2 times 1,500 times 3. That is 900. That is the first loss. The number 2, they said the retained earnings balance is to be eliminated. So it's a negative. Deficit retained earnings. If you check under equity, we have a deficit retained earnings. Deficit retained earnings. Deficit retained earnings. So or we call it accumulated losses. So that is 2918. 2918. Note 3, the following details relate to the assets. Tangible assets, we have 15% of the book value to be transferred to bondholders. So we have the tangible assets to be taken over. Meaning that there is a reduction, there is a decrease in assets to be taken over. Remember that 15% of the tangible assets that is 15% of the tangible assets, which is 5,000, will be used in bondholders to be transferred to bondholders for an agreed value of 720. So 15% of 5,000, this is 750. But now it's being taken over to what? 720. You can see these are, even if they have decreased their liability, because a bondholder is a liability, again, they have done what? They have devalued. They have devalued the asset. A tangible asset is an asset. Devaluation of assets, because this one was taken over at 730, meaning that we have 30. So I will recognize here the first 30. Then at the same time, remember they decreased what? Decrease in liability. Decrease in liability, which is a bond. So the 30. So decrease in liability. Remember that is again. So other than so that is it. That is it. So tangible assets to be taken over, which is a loss, because they have done what? They have decreased the asset, the tangible asset, because now this one, yes, it was transferred. It was to be transferred at 15%, but it's acceptable at 720. Meaning that there is a reduction of tangible assets, that is the one which is taken over, that is a loss. But again, there is a reduction of that liability, the bonds, because the main purpose of that transfer of the asset, the tangible asset at 15%, is to reduce the bond. That is why our liability has been reduced. That is again. So again, we reduce the losses. In the same additional information, they said that the remaining assets are to be done what? Are to be marked up to 110. Are to be marked up to 110. 110. And that one implies that they did what? They increased the remaining value of the assets. They increased the remaining value of the assets. So we can say that other tangible assets. So remember that already 15% has been taken over. So what we are remaining is 85% of the 5,000. But now it has been marked up by 110%. So we need to know the markup. The markup is just this 10. They increased by 10 because obviously our assets would be maintained at 100%. So they increased to 110, meaning that we need to know the 10%. The 10%. We need to know the 10%. So 10%. So 0.85 times 5,000 times 0.1. That is 425. So this is again. So it will reduce the losses. So the next one, the next is they are mentioning about inventories. Includes obsolete items worth 540. So obsolete is something useless. So obsolete inventory, that is a loss. 540. So we add that, a loss. So they say that the inventories include obsolete items worth 540 million below their book value of 680. So the loss is 540. Bond investment having 10 months to maturity is to be revised to 280 from its carrying value of 370. So again, there is a loss there. There is a loss from which value? So bond investment. It was done, was revised to 280 from 370. So 370 minus 280, that is 280. This is 90. That is 90. So these are loss. It was 280 from 370. Receivables with carrying value of 1,200 million are to be factored out for 70% advance. Under which terms? Under terms that will allow for refund of any difference between actual correction and the upfront payment. So that is an advance. That is something coming out after. So there's no gain or loss there. That is just an advance. The next, there is one customer who owes 828 million to million. Is in serious financial difficulty. Only 50% is expected to be received from this customer in 1 year's time. So meaning that we are going to make a loss. We can only recover 50%, but in 1 year's time, meaning that we have to discount that value. We will recover in 1 year's time to the present value. So irrecoverable debts, what can we not recover? Irrecoverable debts. So the recoverable debts, we have 828 minus what? So this one, we can only recover 50% of the 828, but in 1 year's time. So we need to discount this, what we can recover in 1 year's time to the present value. So in that note 3, the last dot, they never mentioned any discount rate. That is why they said in note 9, assume a discount rate of 15%, unless a different rate is more appropriate. So where they have not mentioned any rate, we use 15%. So using the table in note 10, 15% 1 year, that is our discounting factor is 0.87. So this is the same way you could have said 1 plus r raised to n. 1 plus 0.15 raised to what? -1. You could have arrived at 0.87. 0.87. You could have arrived at 0.87. So let's discount then 0.5 times 828 times 0.87. So 828 minus answer, that is 468. So this is a loss. That is a loss. Note 4, the bank has demanded repayment of a bank overdraft, while financing institutions has accepted to receive 92% of their existing loans in new ordinary shares as full settlement. So they are not accepting to be paid 100%. They have accepted that you pay A Limited to pay 92%, meaning that A Limited will not pay 8%. So 8% is again to A Limited, because the financial institutions have just accepted that the loan which is outstanding, you pay up to 92. So loans from financing institutions, loan from financing institution. So the loan from financing institution, they have accepted that you pay up to 92%, meaning there is a gain of 8% times the value of the loan. From the statement of financial position, the loan is stated at 925. So 8% of that, 0.08 times 925. That is 74. This is again, you deduct from losses. In the same additional information, they said upon successive completion of the reorganization process, that one comes after, upon successive completion. So that is after reorganization. It doesn't affect this. Number 5, existing ordinary shareholders are prepared to inject 4,200 for its 40 million new ordinary shares, while preference shareholders are pledged to finance new production equipment whose estimated fair value, even that one is after. Half of the trade payables have agreed to be paid using ordinary shares in the reconstructed farm. That is after. The directors have projected annual profit before interest and tax in the reconstructed entity. That is after. A farm order, that was proceeds The number 9 and 10 is just discounting factors. So meaning that our maximum loss is, so if I take 900 plus 29, 18, plus 30, minus 425, plus 540, plus 90, plus 468, minus 74. So this is 44, 17. So that is the loss. That is the maximum loss. So who will suffer? Who will suffer? The available shareholders will suffer. They will have to suffer in terms of sharing what? In terms of sharing that loss based on their share capital. So we can say that the next one is allocate now. Allocate the maximum, allocate the maximum loss to shareholders. Allocate the maximum loss to shareholders. Allocate the maximum loss to shareholders. So this maximum loss, so we can say, I have said that the people who will share these are the available shareholders. So since the ordinary shareholders, so you can say, if you are writing that since the ordinary shareholders and the preference shareholders, so I can write here, since the ordinary shareholders and the preference shareholders are the only losing shareholder group. Are the only losing shareholder groups. It may be appropriate to ask them. It may be appropriate to ask them. It may be appropriate to do what? To ask them to bear the reorganization, laws. But now in which basis? To bear the reorganization in the proportion, as I have said, in the proportion of what? In the proportion of their capital balances. In the proportion of their capital balances. So if you look at your statement of position, the ordinary share capital, so the capital balances. So the ordinary share capital is at 4,000. Then preference share capital is 1,500. That one we have 5,500. The total capital. So meaning that the ordinary shareholders will take what? Ordinary shareholders will take what? So 4,000 over the total 5,500 times that loss of 44.17. Then for the preference shareholders, so it's all about 1,500 over the 5,500 times 44.17. Times 44.17, 17 times the 44.17. So 4,000, you divide 5,500 times 44.17. So this is 32.12. Then 1,500 divided by 5,500 times 44.17. This is 12.05. This 2 is adding to 44.17. After that, we can talk about other proposed changes. Others, other proposed changes. Like now, if we look at our question, like now note 1, there was some dividends in arrears, and maybe in the additional information, there will be other balances of the preference. So remember that the preference shareholders, they have a preferential right of being paid dividends. So on reconstruction, you need to talk with these people over here. Always on reconstruction, talk with these people. They convert those balances of the dividend or those balances of the preference shares. You give them ordinary. You give them ordinary shares. Those ordinary shares, they don't hold any rights. So obviously, preference, the balances of the preference share capitals, and even those which were in arrears, they have to be converted to ordinary shares. So number one, we can say that the remaining preference share capital, and the preference what? And the preference dividends. And the preference dividends in arrears. Converted into ordinary shares. To be converted into ordinary shares. Number two, additional information. Number two, you can see there was some retained earnings which should be eliminated. Remember, it was negative. It's a deficit, retained earnings. So you cancel out. So deficit retained earnings account, deficit retained earnings account to be cancelled. To be done what? To be cancelled. Then remember, if you check even in additional information number 5 and number 7. So let's start with number 5. So existing ordinary shareholders are prepared to inject 4,200 for 840 million new ordinary shares. So meaning that the existing ordinary shareholders, they are going ahead to do what? To subscribe to new shares in the reconstructed fund for them to benefit from any profit which will arise. Because in note 6 or note 7, the directors have proposed the annual profit before interest and tax in the reconstructed entity of 650. So we have to be looking forward as ordinary shareholders that this profit, for us to benefit from it, let's buy shares. Let's buy shares. Number 3, in exchange of the sacrifice, by the ordinary shareholders, they are to do what? They are to subscribe. For new ordinary shares. In order to benefit from the projected profit. From the projected what? Projected profit. From the projected profit. So, number 4. Remember there were assets which were available. So will these assets remain to be stated the way they were stated in the net book value? No. What we need to do is all about to do a restatement, show that there is their true worth, or we can say restate the assets to their fair value. So assets to be done what? Assets must be restated. Asset values to be restated. Asset values to be restated to reflect their true worth. Or you can say the assets to be restated at their fair values. So this question was having 20 marks. So far, what I've done, you have 10. How are you supposed to get the 10? You see, these are maximum loss. Remember, this one was determination of maximum loss. This one was maximum loss. Here. So maximum loss. You see, they were marking this. And they marked this 4. 1, 2, 3, 4. So far you have 10. How? So out of 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13. Out of the 13, they need any 5, correct? Any 5. If they multiply by 2, you get your 10. You get your 10. You get your what? 10. So far you have 10. So let's look for the other 10. Let's look for the other 10. So as a student of CPA, what I can request is that this work is not even difficult. If you take your time, come in, attend my online classes, because there's classes I do during the evening now where we do a lot of work other than what I have shared in the YouTube platform. There's a lot of work which has been done or which is going to be done for this semester. So there's a lot of work which we always do. It's already ongoing. Yeah? So we do that coverage of syllabus based on questions, and obviously we introduce a topic, we do questions. Then you will be okay to do your exams. So for you to join my classes, you can just contact me through this number. So 0728 760 546. So if you want to join the ongoing online classes, and at the same time, I have started revision classes. So for the guys who by bad luck failed in the last semester, you can come in and do your revision. So karibu sana. There's still time remaining. We have a lot of time. We have more than 1 month, which is more than enough for you to be fit to sit for the April exams. So let's continue. Now the next part is looking for the next 10 marks. We are going to look for the other 10 marks. That is under the revised statement of what? Revised statement of financial position. The revised statement of financial position. The revised statement of financial position. So for the revised statement of financial position, before we do that, there's various workings here, around 3 workings I will do. So I would have to open my ordinary share capital account, because there's various changes which has taken place. The ordinary share capital. I will do my bank account here. So those are enough. And I will come here and do some workings based on the debenture, the convertible debenture, according to note 4. Convertible debenture. But this one I will mention about it. Let's finish first the two. So the balance brought down here. Then balance brought down, if any. So if we look at statement of financial position, we don't have this. This one is 4,000. Then remember when we made losses, when we made a loss, it's a loss we made of 44.17. So these people were taking, so capital reduction. So this one must be reduced. There's a loss. This one took. So he took a loss of 32.12. He took the highest based on his share capital. So is there any balance brought down here? We don't have. But I can check this bank overdraft. So our balance brought down here is bank overdraft, which even they said in note 4 that it has to be paid. And that bank overdraft, according to the question, is at 3,900. 3,900. Then after that, we can go to the additional information. Let's check various things to be considered, which can affect the ordinary share capital. Remember note 4, the settlement of the loan from financial institutions. They said that they were settling this loan, the loan from financial institution. The financial institution accepted that you pay up to 92%, but through what? New ordinary shares. So the loan, so 92% of the 925. So this one was paid through shares. So our capital must increase. So 0.92 times 925. That is 8 words. That is 851. That is 851. All right, let's check anything affecting our capital. Our capital, according to the question. So remember that even based on our proposals, we said that if there's any balances of the dividends, preference dividends in arrears, and any balance of the preference shares, whereby you know that they have to be paid. They have a preferential right of claiming their dues, the preference dividends. So the preference shareholders, they have that preferential right. So instead of paying them, you discuss with them. In case of continuing holding them as a preference, you discuss with them and say that let's give you ordinary shares. So meaning that our capital must increase due to that conversion. So the preference, if you check from the question, the value was 1,500. But remember, the preference share capital took some loss. Under the 44.17, the maximum loss, it took 12.05. So we have to reduce that. And remember, there was arrears, so plus the arrears, the preference dividends in arrears was 900. We have to add that. So remember that we are converting the balance of the preference shares plus the arrears, but we have to reduce with that maximum loss they took. 1,500 minus 12.05 plus 900. So that is 11.95. 11.95. 11.95. Yeah. Note 5. Existing ordinary shareholders are prepared to inject 4,200. So they are buying shares. So meaning that the company is getting money. So ordinary shares. The company is getting 4,200. So meaning that here we can talk about bank, 4,200. Then after that, remember that again in note 5, there is while preference shareholders are pledged to finance new production equipment, whose estimated fair value is 1350. So they are bringing in an equipment. So the preference shareholders, they are trying to raise capital in terms of equipment. So remember, this, again, they have a preferential right on this equipment. So again, we have to say that the 1350 will not continue to be financed by these preference shares. So we have to convert that to ordinary shares. So we can talk about equipment. It was equipment 1350. 1350. The number 6, half of the trade payables have agreed to be paid using ordinary shares. So meaning that the capital must increase here. So payables, so the creditors have agreed to be paid by shares. So our capital must increase. So our payable was at 1968. So a half of that, 1968 divided by 2, that is 984. So balance carried down. So 4,000 plus 851 plus 1195 plus 4200 plus 1350 plus 984. This is 12,580. 12,580 minus 3212, 9368. We check anything affecting cash other than these cash they were receiving through the issue of shares, shares, since shareholders were subscribing to the ordinary shares. So anything which can affect cash in our question. So anything which can affect this aspect of bank, any cash. So remember that there is this additional information number what? Additional information number 3.4. Receivables with a carrying value. So the debtors with a carrying value of 1,200 are to be factored out for 70% advance under the terms that would allow for refund of any difference between actual correction and the upfront payment from the factor. So remember that there's those advance payments made. So the advance payment made at 70%. So that is money you are receiving. So even before you do what? You offer the service or you supply what you are supposed to supply. So you have been given an advance payment. So that is money. That is money. So that is money. So factoring. So remember that it was factored at 70%. So 7%. So 0.7 times 1,200. So this is 840. Then if we go to additional information number 4, they said there's somewhere they said that upon successive completion of the reorganization process, finance institution is ready to immediately buy 15%, 900 million debenture. So a debenture is money you are getting. So they are going to buy 15%, 900 million debenture in the reconstructed entities' debts, provided the directors will attach the right to convert the debt into shares at maturity. The finance institution will also require 10% discount on the convertible debt. So they will require 10% discount. So meaning that finance institution loan so they will accept, they will buy this one, but at a discount of 10%. So meaning that 90% of 900 will be, so 90% of 900 will be 0.9 times 900, 810. 810. So there is no another item which will affect bank other than what we have captured. So balance carried down. So 4,200 plus 840 plus 810. So 4,200 plus the others, which is so the total here is 5850. 5850. So that the balancing figure, if you minus 3,900, you'll be able to get 1950. So for the debenture, the 15% convertible debenture. Remember they said in the note 4 that upon successful completion of the reorganization process, however, the financing institution is ready to immediately buy 15% of the 900 million debenture in the reconstructed entity, provided that the directors will attach the right to convert the debt into shares at maturity. So financing institution will also require 10% discount on the convertible debt at issue and the repayment period of 3 years. And the repayment period of 3 years. And the repayment period of 3 years. The effective rate of interest on this convertible debt, if the discount is granted, is estimated at 18.7. And the effective rate of interest on equivalent non-convertible instruments will be 22.5. So yeah, we have to apply the concept of IFRS 9. We have to apply the concept of IFRS 9. So whereby we will say that you have to split the proceeds. Split the proceeds. So split the proceeds between liability. Split proceeds between liability and the equity. At initial date. At initial date. Liability is given by, how do you determine liability? Liability is given by the present value. So meaning that you have to apply the discount. The present value, you have to apply discounting. So the present value of the expected interest payments. Of the expected interest payments and the principal repayment. And the principal what? Repayments. So how will you do the discounting? At what discounting rate? And the principal repayments discounted at the rate of 22.5%. At the rate of 22.5%, carried by what? This one was carried by equivalent and what? Convertible. Carried by equivalent non-convertible. Equivalent non-convertible debentures. Equivalent non-convertible what? Debentures. So I will come here and say, we have the year, but we have it was 3 years. That is what they said in this question. That the financial institution will also require a 10% discount on the convertible debt at issue and the repayment period of 3 years. So we have year 1, 2, 3. So you have to consider. So it's 15%. So because we have said the liability is given by the present value of the expected interest payment and the principal. So interest is at 15% for 900. So if you apply 15% for 900, so you get future cash flows. Future cash flows. We have shillings in million. So future cash flows. So interest for 3 years, 0.15 times 900. So it's 135, 135. So this is equivalent to 135. Then remember that liability is given by the present value of the expected interest and the principal. So the principal would again be paid in the third year. The principal is 900. The principal is 900. So discount factor, I said at what? At we can say present value interest factor at annuity. Present value interest factor annuity. Present value interest factor annuity. The equivalent non-convertible debenture. So that is at 22.5. So 22.5, according to the table provided in note 10, 0.82. We have 0.82, 0.67, 0.54, and a 0.54. So that if you multiply these and these values, you get what? You get your present values, present value of cash flow. So shillings in million, shillings in million. So 135 times 0.82. This is 111. Then 135 times 0.67. This is 90. 135 times 0.54. This is 70 what? 73. 900 times 0.54. 486. So the liability component present, this is the liability component currently at fair value, because we have done a discount. Liability component of the debenture currently, so 15% debenture. Even this one is what will appear under the non-current liability, the discounted value. So the liability currently, that is 111 plus 90 plus 73 plus 486. So this is 760. So, but we know that the issue value is 900, as given in that note 4. As given in that note 4, issue value. But now they were supposed to be given a discount at issue. So issue value at discount. At discount. Remember the discount was 10%. At the discount of 10%. So the value is 900 of that debenture, but at the discount, so 10% must be deducted from 100. We have 90 times 900. I think there's somewhere we got 810. So meaning that we have a residual amount, which is an equity component here, which is again, so they are playing around to raise capital anyway. Equity component, so the balance there is equity component. The gain, in terms of this liability, there is a gain. It was currently 760, then at issue is return. So there's a gain of 50. So the equity component, which is a residual amount of 50. So the difference, 810 and 560. So we are done with the working. So I can be able to present my statement of financial position in the next 10 minutes. In the next around 10 minutes, we can do the presentation of the revised statement of financial position. Revise the statement of financial position. So A Limited, revised statement of a financial position. Of financial what? Position. I can say immediately after the organization. Immediately after the organization. So we have shillings in million. So we can talk about assets. on which we have non-current assets. So according to the question of ours, remember there was tangible assets. Tangible assets was stated at 5,000, but 15% of it was transferred to cater for the bonds. So meaning that the balance is 85% of 5,000. But this one was done what? Was marked up. The balance was marked up to 110. 110%. So I don't have to determine 10, then again I add back to 85% of 5,000. It's the same as just applying the 110% direct. So you have 4675. Then remember there was an equipment which was financed by who? Preference shareholders. That is according to additional information number 5. So at 1350. Then after that, after this one, according to this question, there is what we call a financial instrument. That is financial instrument. So there was no changes for this one. It's maintained at 1,000. So then we can talk about other current assets. Other current assets. So for the other current assets, remember we have 4125 from the statement, but there is an adjustment. Right now there was obsolete inventory of 540, and that is according to note 3. There is obsolete inventory of 540. There's a bond investment having 10 months to maturity. So that is not the wrong term because they are saying 10 months to maturity, which is less than 12 months. So it's to be revised to 280 from carrying value of 370. So there was again a loss there of 90. And finally, there was this aspect of irrecoverable. The recoverable debt. Note 3, the last dot. Remember, there was that irrecoverable debt of 468. You know how we did it when we were determining our maximum loss. You remember we were doing those computations, mostly the discounting. You remember we did how we got 468 from maximum loss. So this is 3027. Then we did a working for bank. Remember from working, the balance carried down was 1950. So far total assets. So total assets, so that is 4675 plus 1350 plus 1,000 plus 3027 plus 1950. So this is 12002. 12002. 12002. Equity and liabilities. So for equity and liabilities there. So equity and liabilities. We did a working for ordinary share capital. We did a T account, ordinary share capital. So the ordinary share capital was 9368 from the working. Then there's this one, equity component. The equity component. So the equity option, you can say 15% debenture, convertible. We have the 50. So that is 9418. So non-current liabilities. So for the non-current liabilities, we talk about the 15% convertible what? Convertible debentures. So this the discounted value, the liability component, the 760. Then current liabilities. We have the trade payables. Remember, under the trade payables, that is according to addition information number 6. They said half of the payables have agreed to be paid using ordinary shares. So it means that the half is remaining. So I have of 1968. 1968 divided by 2. That is 984. 984. Finally, there's this aspect of note 3.4, whereby they were talking about receivables with a carrying value of 1,200 are to be factored out for 70% advance. So this, remember, this is money you are being paid before you deliver. So this is something you are given. This money you are given before you deliver what you are supposed to do. So this is not your money. It's an advance factor, which is our ability to pay. Advance factor. So 70% of 1,200. So 0.7 times 1,200. We have 840. So let's check if our statement is balancing. So total equity and liabilities. So total equity and liabilities. So 9418 plus 760 plus 984 plus 840. It's okay. It's okay. It's agreeing. And this is equal. That is very good. So how are they marking again? You get your 10 marks so that it totals to 20. So we have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. But they were never marking the one correct entry for 1 mark. No, they needed any 5 correct. So out of 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Out of the 10, they need any 5. They multiply by 2, you get your 10 marks. Plus the other 10, we did area, you have your 20 marks. So this is how you were supposed to do this question for proposing, or we have suggesting a scheme of reorganization. December 2023, question 5. December 2023, question 5. Advanced financial reporting. A unit under CPA. CPA is a course offered by which body? KASNEB. So I can say this. Financial reporting or advanced financial reporting is not difficult if you are on the right hands. So welcome to my online Zoom classes. Welcome to my online Zoom classes. The ongoing Zoom classes plus revision. So what you need to do, you just call plus 254 728 760 546, so that we agree on the way forward. And remember, the main thing is all about yes, I have given you free content here. So how can you be able to reward me? So what you need to reward me is all about you subscribe to this channel. So do a subscription. So you subscribe kindly, subscribe, and at the same time share. I know you are in many groups, you are in various colleges. Share this link to your fellow students so that they can also benefit. So thank you for your time, and karibu sana in this platform so that you can do a lot of work. See you next time. Maybe under the online classes, or maybe when I will be doing what? Another live session.